think that they're going to have pretty insane decisions ahead of them, where sometimes they're facing both inflation and recession problems at the same time.
In today's video, Lyn Alden, an investment strategist and macroeconomist, warns that once the debt ceiling is lifted, Janet Yellen will need to refill the Treasury General Account.
I think it's going to be a mess. And I think one of the, going back in history again, looking at, say, the 1940s, which is the kind of the closest macro environment, oddly enough, to the 2020s environment, that was the last time they tried to come off the zero bound. When they were on the zero bound, they had inflation, and they tried to raise rates off that zero bound. And, the question is, how do they handle it? And the answer was an absolute mess. They basically had to, they did yield curve control. They inflated away a lot of debt. And then they tried to slowly come out of that, zero yield environment back to, getting back towards positive real yields. And it took them quite a long time. And that was an environment with, partial capital controls. That was an environment of no social media. Things happen slower. So you can you get people into these silos and you can slowly change things. I mean, gold was banned for 40 years for Americans. It was kind of it was a weird environment. And essentially, in this, now we're in a fourth turning again. And essentially they're doing this, they're in a same environment where they're obviously trying to get off the zero bound in a very indebted environment. This time, I think the challenge they're running into is they actually took a different course in the playbook. Last time they did basically what Japan's doing now, the yield curve control, raise things slowly. This time they tried to rip the Band-Aid off and just jack rates up. And basically it's emanating into the banking problem, and it emanates into real estate. And I think we see these cascading problems. And I think the challenge is that they eventually face kind of a Minsky moment where they're not able to handle both at the same time, where they basically are in a situation where they try to normalize rates, but that they still have to end up providing liquidity to the treasury market and some of these other kind of core markets. And I think they're going to be in that kind of weird environment again, with the key difference being that we are in a different technological environment now, where we have social media, we have rapid real-time data, we have more free flow of capital, at least for the the Western world. And I think that's the challenge they run into, is that they're essentially applying a 1970s kind of inflation fighting playbook to a situation that's actually more like the 1940s. And I think it will result in some pretty extreme outcomes. So all those numbers prior to that going negative are weekly numbers. It's how much basically the Fed is sending to the Treasury every week. And then they change their calculation in the end there, and it becomes cumulative. Yes. And it kind of damages the chart. So I saw that Jim Bianco, he put out a really good chart that he made the whole thing cumulative. He took that data set and made it cumulative, and it shows that you basically have this line going up for like 10 years, and it starts to roll over. I made a chart where I was inspired by his work, and I made one that was both cumulative, and then I also showed the weekly ones on it as well. And I dove in an article about why this is happening to the Fed, what choices led to this. And that was a few months ago. And essentially it's what you pointed out, that was almost a precursor for what we're seeing now in the regional banks, that the Fed has huge unrealized losses. They have, unlike most banks, they actually have an operating loss, meaning that their liabilities are yielding higher than their assets, which is historically very unusual. Now, unlike a normal bank, they don't have to necessarily make a profit, but over time, it does start to impact a number of things. One is it impacts the Treasury, because the Treasury used to get a revenue source out of the Fed. Now they don't get that revenue source anymore. And then longer term, if this goes on long enough and they dig themselves in a deep enough hole, it actually does kind of bring up questions around central bank independence, because kind of central bank solvency is kind of one of the factors that at least leads them to have some degree of central bank independence compared to what you get in kind of a banana republic, where there's really no independence at all. So over time, if you were to have them hold that level for a sufficiently long period of time, and you have commercial banks have to slowly raise their deposit rates in order to compete with money markets and T-bills, you'd eventually have them all start to look like that sheet, essentially. They'd all start to have these kind of negative profitability, and they would start to eat into their capital. And so I think that they're going to have pretty insane decisions ahead of them, where sometimes they're facing both inflation and recession problems at the same time, or at least kind of back to back. And it's the worst possible environment for a central bank to navigate, because if they have a 1970s style problem with low debt and high inflation, the answer is to tighten. Whereas if you have the combination of very, very high debt levels and inflation, that's when they face kind of the impossible scenario.
They just can't give Janet any more money. So this is, how do you think about that? I've thought about this, obviously, but how do you think about that with the T minus 6 weeks on the debt ceiling?
Well, so the TGA is already getting pretty low, the Treasury General Account.
Yeah.
And so basically what the way this all works is they've already started taking extraordinary measures. It's like if you'd lost your income source and you can't, tap in your credit cards, you have to start drawing down your existing cash balances in order to pay your liabilities. And so that's what Yellen's doing right now. They're supposedly going to get an increase, in these next couple of weeks due to tax season. That's possibly overstated due to how poor most capital gains were over the past year. So we'll see the magnitude of that. The debt ceiling issue might strike more quickly than Yellen has previously estimated. I'm sure there are a lot of people doing really deep research on that. But I think essentially that is a huge catalyst to be aware of, because ironically, it's not necessarily the debt ceiling to focus on. It's what happens right after it. When they resolve that debt ceiling, and the Treasury tries to raise their cash balance back to their normal target level, that's a huge liquidity withdrawal out of the financial system that is already very tight on liquidity. So, autumn of last year basically was kind of a partial turning point in liquidity, because for most of last year, you had the Fed drawing down their balance sheet, and that was obviously pulling a lot of liquidity out of the market. But then starting in the later part of the year, you had the Treasury really begin to offset that to a significant degree. They were pushing liquidity back into the market while the Fed was pulling it out. And so you actually had somewhat neutral liquidity conditions overall, kind of this choppy sideways kind of stagnant liquidity environment. And if you get to the end of that where the Fed is still trying to draw down, and now the Treasury is trying to refill its account later this year, that's a double negative whammy for liquidity, and it might cause one or both of them to have to course correct. But the path between there and here and there, I think, is going to be fraught with volatility.
What do you think about that last point, just fully loaded with the cycle point in time, and agree or disagree with it, and the inability of this damn S&P 500 to even give you a sneak preview that it wants to do something like that?
Yeah, I am very cautious on equities for the next, several months. I think that there are attractive areas longer term, but until we have more clarity on this liquidity situation, we see basically a storm on the horizon. It's unclear how they're going to handle it. Now, if the market correctly sniffs out that, say, the Fed's going to blink and they're going to pivot their liquidity, kind of like they already partially did in March, it's possible the market, say, front runs that, and then it never gets the big sell-off that some of the bears expect. On the other hand, and that's part of why this is a challenging market, because it's so human-driven. We're basically trying to predict what a handful of individuals like Yellen and Powell are going to do. So there's a couple ways they can handle that. One is that, obviously, if they reach very low cash levels, they can shut down the government for a period of time to extend the period that they can operate without an outright default on some of the more either essential payments or the debt itself. So they can extend it with that a little bit, but that obviously has an economic impact on its own right. And then essentially when they eventually have the debt ceiling impasse, one or two things has to happen. Either the Federal Reserve might have to provide more liquidity, which is awkward given their current inflation mandate, or the Treasury, for example, can shorten their average duration of Treasury issuances and try to draw liquidity out of the reverse repo market. But that also, it doesn't make sense from a number of standpoints. That's the most expensive part of the curve right now, and it also deviates from their normal kind of plan of maintaining rather consistent average durations. So I think that's going to be a big challenge for them, and it's just this multi-month period of, we see decelerating profit margins, we see decelerating growth, we see across the spectrum. If you look at all these different parts of the economy, we see labor starting to weaken to varying degrees, even though that's traditionally a lagging or coincident indicator compared to some of the others. Even that one is beginning to show somewhat fairly early signs of weakness now. And I think a lot of recession indicators are kind of pointing towards that same part of the year, as you pointed out, with the liquidity crisis. And I think that cash, T-bills, cash equivalents, not relatively low volatile stocks are ways to maybe weather the storm until we have greater clarity on how they're going to handle these kind of extreme environments.